Hello.
Hi, this is Marie Conser, a real estate broker here in Oregon, rainy Oregon today, actually. Beautiful day in June. And my guest today is Tim McBratney. Tim, welcome.
Thank you. Thank you. Yeah, Tim McBratney with PacRes Mortgage. Nice to be here.
We are going to talk about what's happening in the market these days, and we're going to jump right in by looking at what the inventory is looking like, because we are definitely seeing more homes coming on the market. So on the screen here, we are seeing the last basically 11 years of inventory. And a quick reminder that the inventory is expressed in months. And it simply means that if no new home comes on the market today, this is how quickly the current inventory of homes for sale will sell. And last month in May, we always look back, we were at 1 month. Now in a somewhat balanced market, we have between 4 and 6 months of inventory. And the last time we were at 4 months of inventory was in January 2014. We have been in a seller's market ever since. Now, what's interesting is it went back up, the inventory went back up at the end of 2014, early 2015, because the interest rates were starting to go up, right, Tim?
Mm-hmm. Yes, indeed.
Yep, we were flirting with 5% at that time, and that brought more inventory on the market. And I expect the current rise in inventory to do the same. Now, the story here is that when we started 2020 with the pandemic, we saw the inventory decreasing because we had a very fast moving market at the very beginning of the year, and then pause in April and May because the pandemic hit in March, end of March. People paused and then said, okay, we actually need a different living arrangement, different housing. And we entered this pandemic market that made the housing market really fast-paced, fast appreciating, supported by low interest rates, right? And I mean, we went down all the way down to what, Tim?
2.25, 2.5, and on a 30-year fixed rate.
Right. Which, you know, was done to support the economy, the housing and everything. So what we are seeing today is an exiting of this pandemic market, supported by rising interest rates. Now, if I look back quickly here at the very beginning of 2011, we were still feeling what had started in 2008 with the financial crisis. So it came to, it started a little bit in 2007 in Oregon and really hit us in 2008. And it continued for about, well, three, 4 years. Sorry, I'm going to go back here.
Indeed.
What six is considered, we're starting to get into a balanced market, six to 4 months. And then 2013 is when it really started picking up again. Anyways, in the grand scheme of things, what does those inventory numbers show us is that we are still in a low inventory environment. We just no longer have the interest rates to support that fast-paced, fast appreciation market. We have to remember a home price deceleration doesn't mean a home price depreciation, meaning a lot of people are wondering if the prices are starting to go down, and it's not the case. I mean, I believe that we're starting to see some price adjustments, but I feel like we're going to start plateauing. Some overpriced homes will go down a bit, yes, but overall, between the beginning of this year and the end of this year, I feel we're still going to see appreciation in the single digits. My prediction is between 5 and 8%, where we have been seeing 15% the last 2 or 3 years. So all of this, of course, this deceleration is fueled by the mortgage rates. So Tim, what's been happening with the mortgages? We were expecting mortgage rates to go up this year.
Indeed, yeah. One of the biggest drivers of interest rates is inflation. Obviously, we're hearing the news every single day about inflation. It's about 8.6% at the last reading. And that is the bane of long-term money. If you are expecting a return on your nice investment of 2 or 3%, but inflation is rising at 8%, and you're losing money, you're losing buying power. So consequently, rates rise to compensate for that. And the sad note of that is that with higher rates, people are not qualifying for as much home. They have lower buying or purchasing power, and it's probably dampened the market somewhat. But we don't think that it's going to reverse home values. There's still an enormous amount of home buyers looking for homes in a very limited inventory, as Marie demonstrated with the inventory turn times per month, or the home months on the market or weeks on the market.
Right.
So so the demand still far outstrips supply, and we anticipate that home values will continue to rise, and they have in most recessions. The exception being 2008, 2009 with the mortgage crisis.
Yes, and actually, I have a slide here. I'm going to jump ahead because, first of all, a recession is when we do have an economic activity that is declining, and that needs to last a few months in order to be qualified as a recession. However, that does not necessarily equal a housing crisis. And if we look back at the last 6 recessions, the data clearly states or shows that this is not necessarily, it does not necessarily generate a housing crisis. Now, the caveat here is 2008 was very significant. The recession, I believe, started with the housing sector, but it was really driven by the huge inventory of home that came on the market from people who could no longer afford their home because of the type of loans that they chose to get, which were interest-only loans, number one. And number two, if you were a buyer at that time, it was much harder to get a loan at that time, right? There was a lot of changes at that.
After the meltdown. Yeah, after the meltdown, it was very difficult to get financing. Yeah, indeed.
So if you see an influx in inventory, but less buyer qualifying, we're going to have an issue, or just pure access to the monies.
Absolutely.
And in 91, where we were getting out of the Gulf War, so it was a little bit different. 2001 was a dot-com, crisis. So those other ones are a little bit different recessions.
Indeed.
However, that's where we were at. Now, if we were to compare ourselves today to a time in the past, I would not think of this period of time. I would more think of this period of time between 79 and 82, because that we are seeing similar elements happening. This inflation is more like what happened in the late 70s, early 80s than what happened in 08.
Indeed.
So what does that mean when it comes to buying a home, Tim? What is your opinion if someone is asking you, is it still a good time to buy a house? I have my opinion, but let's hear yours first.
I love it. Yeah, I mean, both Marie and I are in the housing business, and we believe in it strongly. And home values have just continued to tick upward over time. Again, the exception mostly was the 09, 2010 era of the mortgage meltdown. That was just a time of kind of an artificial supply of buyers that drove demand to really outrageous levels, and builders, money was pretty easy at that time, and builders were building homes in droves. And we had probably 3 or 4 million homes available on the market, with about 1 million home buyers at that time, and home buyers were no longer able to buy. So that home values at that time that just pretty much collapsed after 2009 and 10.
Right.
Now we're almost exactly the opposite. We actually have 3 to 4 million home buyers looking for homes with very limited inventory. So while higher interest rates have dampened that somewhat, you have to remember that we had probably at least a third of my long career in mortgage lending has been above 8 or 9%. So if we're at mid fives to 6% right now, those rates are still very affordable in the big scheme of things. And again, it might slow things down, but we anticipate that with the strong demand and limited inventory, that prices will continue to rise. As Marie said, perhaps in the single digit era, 5 to 6% per year, which is still very healthy.
Right. So like you said, we are in this business. I strongly believe that investing in housing, it's very different than investing in the stock market, which you cannot live in a stock, right? But you can live in your house. And it's not a loss of value until you actually sell the house. But in the meantime, you have lived in it. You have made memories in it, and it's a completely different investment vehicle. I also think that with this inventory being as it is, and I expect it to rise between now and the end of the year, I think every month we will see it go up. It's just the nature of the environment we're in right now. Like I said, every time the interest rates go up, we're seeing the inventory increase a little bit. So I expect it to go up, but will it meet all the demand? Probably not, at least not in 2022. The second thing I am seeing is, like you said, appreciation will continue. However, maybe in 2023, that appreciation will plateau more as the interest rates stabilize. So we'll see what happens at that time. Nobody really saw the interest rates rising as quickly as they did so far this year. What the experts were predicting is interest rates reaching that level by the end of this year. So it definitely went much faster than we expected and anticipated that anyone did. So I think it will decelerate the appreciation, but reversing it, probably not. So it's still a good time to buy. But it's more important than ever to connect with your lender on a regular basis and make sure that what you qualify for is on the forefront of your mind here when you're shopping for a house.
Indeed.
Because it can change from week to week in this current environment, right, Tim?
Yeah, absolutely, for sure. And I know many people have been watching what the Feds are doing on the short-term basis. They just rose the prime lending rate, overnight lending rate by 0.75% this week. It does not translate to a 0.75% rise in your mortgage rate. In fact, we were hoping they would raise rates that much on Wednesday because it indicates to the long-term money that they're serious about inflation and doing something about it now, which will really help relax long-term mortgage rates. And in fact, mortgage rates improved that very afternoon. So we're very excited about it. So we're hoping for the best, and we'll see if they remain at this level for a little bit and possibly go down. It's hard to say in this crazy market. We need to see inflation numbers come down, but it is still a good time to buy real estate.
Right. I want to add one more thing. Even if you were to get a 6% interest rate on your mortgage, and that is of concern to you, the likelihood of the interest rate staying high for 30 years, if you were on a 30-year mortgage, because that is a 6%, right? Mm-hmm. Well, historically, we have not seen interest rates staying high for super long, right? I mean, they go up and down. They go up and down. So if at some point those interest rates go below what you have the opportunity to refinance, correct?
Absolutely. Yep. And we're we anticipate perhaps in a couple of years, if we drop back down to high 3s or 4, then there will be opportunities to save you money every month with that lower rate. So we are happy to calculate the cost of the transaction to lower payment, and usually that makes sense. So we'll indicate at that time. But our business is very cyclical. We see cycles of 5 and 10 years, and we anticipate that it will be no different next time. We'll see this cycle change.
All right. Well, thank you, Tim.
My pleasure. Always good to see you.
Until next time.
All right. Bye-bye.
Bye.